Good afternoon, everyone. Welcome back to the Peterson Institute for International Economics. We're delighted to have with us a lively crowd of great people here with us, and also, of course, on the web, watching the webcast live, and all the ships at sea, as they used to say. I'm Adam Posen, president of the Peterson Institute, and one of the pleasures of my job is, in general, getting to host about half our meetings, but in particular, getting to host some of our special meetings, some of our recurring meetings. We had one just 2 days ago. We had the 11th annual Marina and Bob Whitman lecture, which was well attended and was very interesting because Yu Yongding, former member of the People's Bank of China, gave the lecture and presented his rather stark and in some ways upsetting views on the Chinese economy and its prospects. Today, as you know, we are here for our semi-annual regular Global Economic Prospects meeting, which is always led off and coordinated by David Stockton, who I'll come back to in a moment. But in recent years, we have almost always had Nick Lardy in the second chair. And given recent events, as well as some scheduling issues, today we are changing our standard order, and Nicholas Lardy is going to give the first talk, discussing his views on China's outlook, which you will find are markedly more, let us say, optimistic, he would say realistic, than many of the market views and many of the people panicking, and for that matter, differ from our distinguished guest, Yu Yongding, the other day in some ways. As I don't think Nick needs much of an introduction. As you all know, he is the Institute's Anthony M. Solomon Senior Fellow, has been here for over a decade. He is the author of the book published a few months ago, Markets Over Mao, which has been widely acclaimed and reviewed throughout the financial press. We were very glad to earn a review from our friend Peter Orszag in Bloomberg Views. And Nick is, of course, also deeply engaged in the day-to-day developments of China, and we are going to have his views. I particularly want to stress that one of the reasons I admire Nick so much is for all his distinction and eminence, he remains a data hound. I remember being with him in China on a trip and him telling me about how when he was doing his dissertation, I won't say how many years ago, on the Great Leap Forward, he was busy going to Taiwan and Hong Kong and digging up books to look at agricultural statistics and came out in a very different place and turned out to be the right place on the interpretation of the Great Leap Forward than the received wisdom at the time. I don't know whether Nick is right now. I do know that he's professing his views not to be contrarian for contrarian's sake and not to make friends, but because he believes it's right. I know he's got an incredibly sophisticated view of the Chinese data and the economy, and I know that generally whenever I've disagreed with Nick on these things, I've tended to be wrong. So with that in mind, I'd like to invite Nicholas Lardy to the stage.
Thank you very much, Adam. I think Adam's already kind of set out one of the main themes. I think the dominant narrative now, every day in the Financial Times and almost every other financial newspaper, is telling us how China's economic growth is slowing, that the official data are not to be believed, that the advertised growth of 7% is a huge overstatement. I'm going to review China's growth pattern over the past 5 years or so. I'm going to focus on the changing sources of growth, the rebalancing that has been underway since 2010, and I'm going to say a little bit about the implications of this for China's contributions to global trade and global growth. To anticipate, I'm going to argue that the widely held view that growth has declined to maybe only 3 or 4%, as a lot of people are saying, is not well-founded. I think services have replaced industry as the main driver of Chinese economic growth, and that services growth has held up pretty well. The expansion of services has led to stronger employment growth. Stronger employment growth has led to more wage growth. More wage growth has led to more consumption. An increasing share of this is on services, and we are at the beginning, I think, of a somewhat virtuous cycle. On the international side, China's interaction with the global economy, I think, has changed quite substantially over the last 5 years. Exports have actually been a net drag on China's economic growth every year since 2008, dragging down growth by about 1 percentage point. Trade to GDP ratios have declined dramatically. So I think as China moves into the more services/consumption-oriented growth, we will see this trend continue, and China will not be playing quite as big a role in the expansion of trade and the global economy. This diagram is pretty straightforward. Again, when you read the newspapers, some people are talking about the slowdown as if it just started yesterday afternoon or the previous quarter. If you focus on 2010 onward, you can see growth has been declining fairly steadily. Whether you measure it from the pre-global financial crisis year of 2007, which is the big spike, or the little spike, which is 2010, China's growth has been slowing down. The primary reason, and I think I've said this on this at this podium before, the primary reason is that property investment has moderated. At the recent peak of 2010, property growth was running about 33%, but that has declined substantially over the last 5 years. In the first 8 months of this year, we're looking at property investment growth of only 3.5%. So we have a moderation and the ensuing growth slowdown. But I think this should be welcome. China was overinvesting in property for many years, still is to some extent. The overinvestment is roughly on a par with Spain and Ireland pre-global financial crisis, so I think this is a necessary adjustment. It's part of the transition to a more sustainable path of economic growth. The effect of the property turndown, of course, has dragged down the output of steel and cement and raw materials required to produce those kinds of things. Electric power also is only growing 0.5% in the first 8 months of this year. And the decline in many of these things has led to this slowdown in industrial growth. Again, the financial press comments on the decline in industrial growth as if it's something new, but it's been declining every quarter, as you can see, since the beginning of 2010. The good news, however, is that since 2010, the services sector has slowed down by much, much less. You can see that industrial, I've switched a little bit. This is industry only. This is industry plus construction, what the Chinese call the second part of their economy. And you can see the slowdown is quite dramatic for industry plus construction. It's declined, the growth rate has declined by about 3/5, and for the services sector, the decline has been much less. It's gone from around 10 to about 8.5. So the service sector over the last 5 years has held up pretty well. And although you wouldn't know it from reading the financial press, the PMI for services or for non-manufacturing has also held up very well. It's today roughly where it was at the beginning of the fourth quarter of 2014. So the service sector does not seem to be heading for a substantial slowdown. The result is that the tertiary sector has now become a much larger share of GDP. If you look carefully at this diagram, you will see that the tertiary sector, the service sector, was almost completely stagnant as a share of GDP up to 2010, from the time China joined the WTO up to 2010. Remember, this was the period of significant undervaluation of the currency, substantial financial repression, both of which led to very, very rapid growth of the industrial sector and very little growth of services relative to GDP. And those factors have either been eliminated or substantially reduced over the last 5 years, and services have grown much more rapidly, as I showed you, compared to the industrial sector. And the result is now that services are roughly 50% of GDP. The industrial sector is only about 36% of GDP. So my view is essentially that the industrial sector is getting far too much attention by analysts and brokerage firms and so forth. And it's primarily because we get very good monthly data on the industrial sector. We get value added. We get output of dozens and dozens of products. And on the service sector, all we get is quarterly data on value added and very few data on the service sector output. Part of the reason for the growth of the service sector is that household consumption has been improving. We are now in the 5th year in which household consumption as a share of GDP has gone up. It hasn't gone up very much, as you can see on the diagram, but it's a very substantial change from the previous decade when the household share of consumption in GDP was on a continuous decline. So this is a very important part of the rebalancing, and it's very much tied into services. I think roughly speaking, we know now the World Bank classifies China as an upper middle income country. People are spending more and more of their consumption dollars or their consumption RMB on services rather than goods. I think over the last 20 years, the service share of private consumption expenditure has roughly doubled from in the neighborhood of 20% to perhaps as much as 40%. So the rising consumption, shifting share towards services has helped to grow the service sector. But there are some people who don't even accept that the service sector, which according to official data is growing at about 8.5% in the first half of this year. So I just looked for a few pieces of data. It's very hard to find, and these things don't prove anything, but most of the indicators you can find for the service sector are growing at double-digit rates. Here's my favorite, box office revenue, up 50% in the first half. It grew 30% in 2013, 35% in 2014, 50% in the first half of this year. This is indicative of how people in China are spending their money now. They're spending it on entertainment, recreation, and so forth, as you can see in this diagram. Another one is, passenger traffic. The freight traffic is going down, as you can see in the diagram. That's one of the components in the famous Li Keqiang index. Li Keqiang, who was the first party secretary in the Liaoning province, said to our then ambassador Sandy Rant at a private dinner in 2007 in Beijing that he never looked at the GDP numbers. He had his own index, which was freight hauling, electric power, and bank loans. Well, he came from the most industrialized province in China, and back in 2007, industry was the biggest driver of economic growth, so probably wasn't a bad kind of shortcut method. But as you can see here, freight hauling is way down. And the reason is steel production's down, electric power isn't growing anymore. Most of what the railroads haul in China is coal from Shanxi province to the coast, and so freight hauling is down 10%. So the Li Keqiang index is not doing very well. Some people are still compiling it, by the way, and you can see it quoted. But if you look at passenger traffic on the railroads, the growth is running at about 9% in the first half of this year. Similarly, for civil aviation, a pretty strong uptrend for passenger traffic on China's airline system, running way ahead of GDP growth. So at least some of these indicators suggest, at least to me, I'm not dismissing the 8.4% growth of services value added in the first half of this year. There are plenty of components of services that are growing fairly rapidly. Well, now, how does this feed back in this virtuous circle that I was talking about? Well, the important factor is that a 1% growth of the services sector in China creates about 1 million new jobs. A 1% growth of the industrial sector creates about 500,000 new jobs. So as growth has tended more towards the service sector, employment growth has actually held up fairly well. The bars here are showing you how many new jobs, new urban jobs have been created, and the red line, if you can see it, is the growth of GDP. So if you look at growth has come down substantially in 2014 to 7.3%. It was growing at 10.6 in 2010. Remember, I've been focusing on the last 5 years. New job creation in 2014 was 13.2 million. That's greater than the 11.7 million jobs created in 2010. So job creation has actually improved a little bit, even as growth has slowed down. This trend is even stronger this year. In the first 8 months, the new jobs created in urban China are running at about 9.5 million. So they're well on track to set an all-time high record in the growth of urban employment. This is very important. It makes it possible for the regime to take a more relaxed attitude on the growth slowdown. It makes it possible for them to have a much more conservative monetary policy with growth of credit that has now slowed significantly in the past 2 years as they've come to recognize some of the financial risks associated with a large buildup of credit that occurred during and in the immediate aftermath of the global financial crisis. Well, let me turn to the changing dynamics on the trade side. How has the change in growth affected China's interaction with the global economy? Imports and exports have continued to expand in absolute terms, but this diagram shows us that they're down quite substantially as a share of GDP. In other words, GDP growth has been much more rapid. If we look, the export share peaked at about 36% of GDP in 2006. By last year, it was down to 22%, so it's a fairly sharp decline, obviously in part because of the slowdown in global trade and global growth, but probably also due to some structural factors. Imports have fallen from their peak in, I believe, 2000, well, you can see it on the diagram, earlier peak of something around 2004. This is partly a result of the build-out of the supply chain within China, which means more of the inputs that they used to import are now being produced domestically. And it's also in part a function of the change in the dynamics of growth, more service sector oriented, and the service sector obviously is much less resource intensive than the industrial sector, which leads to a slowdown in the growth of imports. A very large share of China's imports are minerals and raw materials and so forth. Part of the decline on the import side, obviously, is also some softening of commodity prices, and that would be more pronounced if I had the data on this slide for 2015. But it's not all prices. This is looking at total freight turnover, total trade turnover measured in tons. You can see it's still going up. The bars show you it's still going up, but the growth rate has declined dramatically. It was well over 20%. It's in the neighborhood of 25% in the pre-global financial crisis period after China joined the WTO, but we're down now to about 6% last year, and it will possibly be even in negative territory this year. Focusing a little bit more on commodities, I don't want to get into the details on commodities, but this is the second to the last slide, and it just shows you what's happened to primary goods imports. So this is mostly minerals and raw materials, also some agricultural, soybeans and a couple of other things like that. This is primary goods. These have leveled off in recent years in absolute value terms, as you can see from the bars. And the growth rate, which in the pre-global financial crisis period averaged 35%, is now down to something like minus, I can't quite make it out, it's minus a few percent. So the growth of these imports has gone negative compared to an average of the pre-global financial crisis period of something like 35%. So this is a very substantial influence on countries like Brazil and Australia and Mongolia and Peru and a few others that have been substantial beneficiaries of China's growth in the first decade of the 2000s. So my last slide, just a quick summary. I think China's growth is slowing, but I think the 3 to 4% range seen by many is not plausible. I think China's transition to growth fueled more by consumption and growth of the service sector is well underway. It's still slow, but it's gotten started. Tracking this transition in real time is very difficult because we don't get very timely data on the service sector. I think that will continue to be a problem. I think you will continue to see in the financial press and the other sources that people are still putting most of their emphasis on the industrial sector, even though it's a significantly smaller portion of the economy than services. And I think the transition will continue, and I think it will have substantial implications for global growth of global trade and output as services, which are going to be much less trade intensive, become an increasingly important share of China's economy.
Can I ask you to take the middle seat? Can I ask you to take the middle seat? Fantastic, Nick. We are breaking a little bit with our normal format. David and I decided that we should go right to questions for Nick. As Nick gets settled, I'll just make 2 points. First is, I told you he's a data hound, and I want to pick up on one thing. If you look back at some of his charts on services and various growth statistics of components, you'll find that not all of them is on the bottom data source, does it say Chinese ministry. Some of them come from ministries you haven't heard of or thought about. And this is actually important. As some colleagues at the IMF were saying to me the other day, China is improving its statistics and increasingly is decentralizing its statistics. That doesn't mean they're all right and they're all unbiased, but what it does mean is some of these conspiracy theories that are out there about, oh, they're going to make sure the number reads 7, whatever happens, are becoming less and less credible because simply the number of data sources and the independence of data sources is going up in China. And Nick and our staff will, of course, be tracking that. The second point I wanted to make is, obviously, we are doing a lot of work on China, which underlies what Nick's talking about. We have outside and will have up on the website a number of our recent publications, including a very good paper by Nick and Nicholas Borst on financial stability in China, but also a new collection of essays from our fellows on China, edited by our China program manager, Sean Miner, and I encourage you to look at that. The final thing I would say is, if you look at around slides, I don't know, I guess it was around slide 10, Nick is talking about this change in expenditure patterns. This is a critical determinant of trade flows and of growth. And our third speaker today, Dr. Paulo Moro, is going to be putting that in a broader global context on his current work on projecting some of these consumption patterns around the world. But enough of that, enough preview. Let's get back to the meat with Nick. Before I open up to questions, Nick, let me ask one thing, intentionally meant to provoke you a bit. You didn't have a single chart about indebtedness in China. You didn't have a single chart about the stock market. You didn't have a single chart about real estate prices. And our distinguished visitor and colleague the other day, Yu Yongding, made a big point in particular about corporate indebtedness in China. Others have made points about the local government. Why were you feeling you could skip over this, and how much, don't say it's because I limited your number of slides, and how much is it a downside risk in the near term that you think you need to worry about?
I think the rise in indebtedness in China is really basically unprecedented. It's not only the high absolute level, but the relatively short period of time that this debt load has increased. So I do think it's a risk, and that's why I mentioned I think it's a good thing the authorities have substantially slowed down the rate of growth of credit creation, both in 2014 and in 2015, although I quickly add it's still growing more rapidly than GDP, so the debt ratio is going up, but at a much, much slower pace. I think I've addressed some of these things before. I start out by noting that this debt is almost entirely domestic. There's no foreign currency mismatch. A few firms have some foreign currency borrowing, but China's gross foreign currency debt to GDP is the lowest of any country in Asia. Most of the credit, the vast majority of the credit, comes from very large financial institutions in China, banks. They are almost entirely funded by deposits. They do not depend on wholesale markets at all. These big, significantly important banks are actually net lenders into the interbank market. So you could have some stress in some very small financial institutions. A sudden stop kind of phenomenon could occur for them, but they're not significantly systemically important institutions. Also, the nature of the credit has changed very dramatically. 10 years ago, 8 years ago, it was all coming out of banks. Then we had this massive growth of credit out of the non-bank financial institutions, which some people call shadow banking. There were, by the time we got to something like 2012, 50% of the credit was coming out of these less well-regulated institutions. A whole new series of prudential regulations have been put in place now. And the bank share of the credit expansion is back up to 75%. So there are risks. I don't think they're immediate risks, and so I think they're manageable. I mean, I think Yu Yongding is right to say this is a cause for some concern, but I think it's going to be a manageable transition. Property's actually picked up. The number of cities where prices are falling has declined in recent months. The number of cities where prices are going up again has improved. And surprisingly, sales of property, which declined by something like 7% last year, are up 17% this year. So inventories of unsold property are declining, and essentially there is a possibility, I didn't want to emphasize it because I've already maybe a little too optimistic, it might be the case that the drag from the property sector on GDP growth will ease substantially over the next few quarters, and sometime in 2016 could turn slightly positive. But I'm not forecasting that. I'm just saying that the property, many people have been predicting the bubble would burst. It hasn't, and actually the situation in recent quarters has been one of slight improvement from a not good situation.
No, that's a terrific summary of your views. Thank you so much, Nick. I'm now going to open up to the floor for on-the-record questions. Jessica's in front with a movable mic. There's also a standing mic in back. Basically, if you're in the last row of tables, please go to the standing mic. If you're in anywhere front of that, raise your hand, and Jessica will come to you to be recognized. Please, who would like to offer a question or comment for Nick? Krishna.
Krishna Guha, Evercore Partners. So, Nick, very much enjoyed your presentation. Some of the people who flag up risks around China highlight the fact that although the investment share of GDP has come down in recent years, it's still very elevated by global standards. And they ask the question, so what would happen if, in light of a subdued demand environment, the Chinese corporate sector significantly retrenched investment? So, with it forming a large share of GDP, a 10, 20% reduction in the level of investment spending could generate not simply weak growth, but a very severe economic weakness. So that gives rise to the sense that while the base case may be fairly moderate growth, there is a significant downside skew, which of course also has to do with the banking-related risks that you talked about. Could you comment a little bit on the extent to which you accept that there is a significant downside skew relating to these and some other issues?
Well, Krishna, I basically accept the premise of your question. I think the transition to a more sustainable level or share of investment in this economy is going to be challenging, and it's going to take some time. If it's done rapidly, then, of course, the economy could collapse quickly. The reason I don't think it's a huge risk involves disaggregation. Again, what we've seen already is that profitability in the state sector has been particularly hard hit as the economy has slowed down. They're already investing a lot less than they were before. Whereas overall profits are down significantly, it's mostly in the state sector. Profits for private companies are still rising, and they're investing more. So when you disaggregate, and remember the state sector accounts for maybe a third of GDP, and a big chunk of this is in education and public health and things like that, which is a little bit different from the manufacturing. The manufacturing sector, state companies are only responsible for about 10% of investment these days. So most of it's in the private sector. The second thing is that they have done a reasonably good job, and I think they have the potential to keep infrastructure investment at a reasonable pace. I don't think there's a huge upside from where we are now. They've already built out the world's largest network of high-speed rail. They've built dozens of new subway systems in a number of cities over the last 5 years and so forth. But investment in infrastructure is still growing at roughly 20% in the first 8 months of this year, and I would think that they certainly have the fiscal capacity to continue that. So if you start disaggregating investment, private sector is still investing, investment is still growing. The state companies, which are a small share of the total, is shrinking, and the infrastructure portion is still holding up. So that kind of picture, which is more disaggregated, I think gives you a little more confidence that they can avoid this kind of collapse of investment. I'm saying it's not a zero risk, it's a risk, but maybe not as big as some people are thinking.
Great. Who would like to come up next? Yes, please. And if you could, just identify yourself when coming to the mic.
I'm Peter Batelier. I'm Johns Hopkins Science. Nick, just a few days ago, another speaker, Yu Yonding, as Adam was saying in his introductory remarks, presented a very different picture of what lies ahead. his main argument, if I recall correctly, was that productivity has been declining now for quite a while in China. Whichever way you measure it, labor productivity, returns on capital, and total factor productivity. I think we can all agree that in the long run for any major economy, factor productivity, efficiency is perhaps the most important driver of growth. What are your thoughts on that? Why do you, by implication, disagree with Yu Yongding about the productivity outlook for China?
Well, I don't want to make this, it's a very valid question, Peter, don't get me wrong. I may have overset this up as Nick versus Yu Yongding. They're both dear friends and respected people, and so they're allowed to differ without it being a name issue, as you well know. But I do want to just pick up on one thing from Peter's question. I mean, this occurred to me on your slides 12 and 13, where you point out it's really nice, this goes directly to Peter's point, it's really nice that we're getting twice as much job creation per unit of growth in the service sector as in the backwards old sector. But that, of course, means that productivity in terms of labor GDP output per unit of growth is going down. So I don't want to say it's a paradox, but how do you interpret this tension that they're reallocating resources to, we think, better uses, but at the same time, as Peter points out, labor productivity is in trouble?
Well, there are many different metrics you can use. There's no doubt that productivity, whether you're measuring return on assets or labor productivity or total factor productivity, has declined quite a bit in the last 5 years. I think a significant portion of this is cyclical. I mean, we won't know until we get off this secular decline or seemingly secular decline in economic growth. But again, when I disaggregate, you see return on assets holding up very well in the private sector, which is dominant in the manufacturing sector, and the state sector has return on assets that are, at best half the cost of capital. So the view that this economy can do well over the medium term is a function of the assumption, which I should have made more clear. But remember, I didn't give you a forecast. I was very careful about that. Depends on much more significant reform that brings more competition into the state sector, which causes these firms either to pick up their game and increase their productivity, or for them to exit, either all at once or gradually by continuing to shrink. And if you look at the sectors where the state dominates completely, like telecoms, upstream oil and gas, the returns are very, very low. The degree of protection from private firms is extremely high. So I think a big factor will be, how much reform is introduced in these areas, how much additional competition will be introduced, and how this plays out. So I think there's potential, because even when you compare in the steel sector, which is now more than half private companies, or half the output is produced by private companies, they have a return on assets that's about 10 percentage points higher than state companies. So even when you're doing apples to apples, there's a massive gap in that particular measure of productivity.
Great, thank you. I promise to stay quieter on the next question. Somebody else? Really? Nick's that persuasive? I should introduce, this is Pedro da Costa, who today is his first day at the Institute. He was a distinguished economics and Fed reporter for Reuters and the Wall Street Journal, and he's joined us as an editorial fellow. He's going to help us translate some of our work that isn't as crystalline clear as Nick's into the web, and work with Steve Wiseman in our publications department. So welcome, Pedro.
Thank you.
Make it a good question, Pedro.
I will. I'll try my best. So it's nice to hear from an optimist, because there's so much bearishness out there about China that it's nice to hear from, it's always nice to get a contrarian view. As a reporter, you always want the other side. So my question to you is, what would it take for you to become worried? Today we had a services PMI reading that I believe was fairly low historical reading, which indicates that the part of the economy that you see as the strong side is also weakening. What kind of indicators would it take for you to start getting less bullish?
Well, I don't put too much weight on PMIs, but the PMI that came out today for non-manufacturing was within 1/10 of a percentage point, 53 point something, within 1/10 of a percentage point that it was in the latter part of 2014. There's some bouncing up and down, but basically it's pretty flat. What would it take me to be more bearish? A more substantial correction in the property sector. I mentioned that there's been an improvement in sales, but investment is still going down. Starts are down cumulatively more than 30%. And if property investment doesn't just decelerate but goes negative, next year by 10 percentage points or more, it's going to knock up at least a percentage point off GDP growth. So I still think that one of the biggest risks is in the property sector. The other thing that would make me very pessimistic would be if I saw a huge effort on the part of the government to kind of reflate the economy through expanding credit. As I've mentioned before, that has not been happening. Again, the financial press constantly is talking about cuts in the required reserve ratio as if this is a big stimulus. The cuts in the required reserve ratio are an offset to their foreign exchange operations, and they don't really tell us very much about what's happening to credit. You should be looking at the growth of, M2, or look at the average interest rates charged by banks, and those are still relatively high. So if they gave up this slowdown in credit, I would become very pessimistic because I don't think it's a sustainable long-term strategy.
Someone else? Yes, please. Could you go to the back mic?
I'm Yu Zhenzhang with Xinhua News Agency, and my question is about China's efforts to push the RMB into the IMF SDR basket. And last week, the Obama administration said the United States will support China's such kind of efforts. And do you believe that it's very highly possible for the RMB to be included in the SDR basket? And another question is about how do you evaluate China's efforts to push this move, as China promised to subscribe to the IMF SDDS, and yesterday the IMF published the international reserves data, and which included China's. And so how do you evaluate China's efforts to push the SDR basket? Thank you.
Thank you very much.
Yeah, well, I think, they have now been providing data for 3 consecutive months on their official foreign exchange reserves and other reserve holdings. According to the IMF template, we now have the data for the end of June, end of July, and as of yesterday, the end of August. This is certainly one of the key steps to come into compliance with the special data dissemination standard that the Chinese pledged to do by the end of this year. So they're making progress on that. Then, as you mentioned, they've now at least begun to disclose the foreign currency composition of their reserves, at least on a partial basis. I'm not quite sure. They say it's representative of the holdings. I'm not sure why they're not telling us what the whole thing is. But and they've done quite a few other things. They're opening up the interbank market to central banks, foreign international financial institutions, sovereign wealth funds. They're also opening up to those same organizations and institutions access to the onshore foreign exchange market. All of these things were mentioned in the report, that very comprehensive report that the IMF put out on the evaluation of the SDR sometime in the first week of August. So I think China is going all out to address as many of the concerns that were raised in that report as possible, including, my interpretation, their August 11th move to have a more market-oriented exchange rate, although it hasn't quite turned out the way they hoped. So there are probably people in this room that have a much better idea about whether or not the vote is going to be favorable to China. I think it's quite likely that when the vote occurs sometime next month, that the RMB will become the 5th currency in the basket.
Someone else? Yes, please.
Harm Zebrechts with Goldman Sachs. You mentioned that your outlook depends on successful structural reforms. Within that agenda, SOE reforms are very important. How do you assess the recent SOE reform plan that was announced? Is that going in the right direction for you?
I think their recent announcement on a document on SOE reform was quite frankly, very disappointing. It's a hodgepodge. It has some good things in it. It has some bad things in it. It's obviously a compromise among quite a variety of competing interests within China. And so I don't think it's going to tell us too much about actually what they do. So to me, the answer has to be we have to watch and see exactly what happens under this rubric or this document that they put out. If they follow the conservative parts of it, nothing will happen. If they follow some of the more enlightened things, we could have real progress on SOE reform, which I've indicated is central to addressing the question that Peter raised about productivity growth and ultimately about sustaining a reasonably rapid economic growth. So anyway, the bottom line is the document was a disappointment.
Is anyone else? Let me just pose one more policy question to you, Nick. Less forecast, more policy. If the Chinese government, as you say, the People's Bank is essentially neutral on your view in terms of changing stimulus policy. If the Chinese government decides to engage in fiscal stimulus of some sort, what could they do realistically in the next year that wouldn't be about stimulating credit and perpetuating the cycle you don't want to see?
Well, I think there are opportunities. And a lot of people have made suggestions that there are things they could do that would be a direct stimulus to consumption. Their contribution rates to the various social programs, the wage contributions for the 5 insurance programs, unemployment, health insurance, retirement, workers' comp, and maternity leave, is something like 22, 24%. It varies a little bit by province. This is a massive amount, so they could reduce this substantially. It would take a big hit. They'd have to allocate fiscal expenditures to these programs, but it could lead to substantial increase in wages for a very large share of the population, and that would have a very positive effect on consumption. Obviously, they don't have to do it all at once, but they could reduce these taxes over some period of time and increase the budget deficit, which is actually fairly small. And we talked earlier about the debt, but the central government, plain vanilla Ministry of Finance debt is still, I can't remember exactly, but it's something like 30% of GDP. It's not a big contributor to China's overall very high level of debt to GDP. So there are some things in that category that could have a catalytic effect on consumption that would reinforce some of the trends that I talked about.
Terrific. Well, I hope you'll join me in thanking Nick Lardy. I think it's been a great presentation. Now, I'd like to shift gears. This was not a political message that China's #1 and U.S. is #2, despite our publishing Arvind Subramanian's eclipse. Nick is free to escape, and I will turn instead now to the economist who has been running our forecasts, and especially, of course, the expert on U.S. fiscal and monetary policy, Dr. David Stockton. Dave, I think all of you know, is the best career central banker we got. He was, for 11 years, the chief economist at the Federal Reserve Board, ran their forecasts, ran many of the analyses given to the Board of Governors and the Federal Open Market Committee. He's been with us since leaving the Fed. He also is a senior advisor to macroeconomic advisors. He speaks today, of course, like all Institute fellows, on his own terms, subject to the Institute's quality control, but he can say whatever the hell he wants. Most of all, I'm grateful to David for continuing to keep us abreast of U.S. developments and engage with so many of our community on this. What some of you may not know is he now, in addition to those titles, is sort of running a how-to-do central banking consulting operation. Previously, he helped out my alma mater, the Bank of England, and he's in a new engagement for the European Central Bank, and we will hope for good things to come out of that. But today, the U.S. and the world. David, please.
Thank you, Adam, and thank you, everybody, for braving the rather soggy weather to come and get a dose of the dismal science. I won't disappoint you. There'll be some dismal science here. I'm calling the global economic outlook uncomfortably close to the edge. It's not so much exactly the baseline forecast looks especially troubling. It's really the risk, which I do see is decidedly asymmetric to the downside. A year ago, I think everybody was anticipating that 2015 would be a year where there would be some modest improvement in the pace of global economic activity, driven by ongoing growth in the emerging market economies and some improvement in the advanced economies. Well, as things have worked out, we're now looking at a situation where it looks like growth in the global economy is likely to slow this year from last year, and it's a real mixed bag, as you can see. I think for the euro area, our optimism, which we expressed in the spring forecast, really is still looking pretty good. I think it seems quite likely that Europe is picking up. And if we get the 1.6% that we've penciled in for 2015, that will be the strongest growth in 4 years. Japan, by contrast, has been clearly disappointing. And while I'm not forecasting recession there, I'm not forecasting much growth either, and only modest improvement in 2016. The tailwinds that we had expected from the depreciation of the yen and the lower energy prices just haven't materialized with the force that we were anticipating. It's clear that the United Kingdom's lost some momentum, but I still think there the growth prospects look reasonably solid. I think policy remains supportive, the labor market's continuing to improve, the household sector looks reasonably strong. My forecast, and Nick makes it clear he doesn't forecast Chinese GDP, but this is my imitation of Nick forecasting China's GDP. So I bought into his story. And in fact, the concerns about China are overblown, and that we'll see some deceleration there as this transition between the industrial sector and services proceeds. And in India, I'd just say steady expansion. Things look pretty solid for India at this point, and policies look conducive to growth, including monetary policy. What's not on this slide, and where the real problems are, of course, are serious recessions in Russia and Brazil, and I think more significant softening in Turkey, South Africa, Malaysia. We had, in the spring, talked about a below consensus forecast for both Russia and Brazil, but even that has now been outflanked by weaker data than we had anticipated. So this all adds up to a baseline forecast, a very soggy global economic outlook, not over the edge, but just close to the edge. For the United States, if you were to look at the top line of the GDP growth that I've put in here, you wouldn't actually believe that the U.S. is the star performer in the global economy. But indeed, that is the case currently. And I've been saying for some time that this kind of growth in the 2 to 2.5% was about as good as it was going to get. And I think that still looks like the case to me. We've got above trend growth, modestly above trend growth, resulting in a modest decline in the unemployment rate. I do think inflation is likely to slowly move back to target, but in this forecast, even by 2018, I'm still below the Fed's 2% inflation forecast. Those of you with long memories, which I hope there aren't too many, will look at this top line and say, geez, isn't this weaker growth than you were forecasting in the spring? And indeed, it is. But it isn't because aggregate demand is disappointed relative to aggregate supply. It's because aggregate supply continues to disappoint in terms of the growth of productivity in particular. For the last few years, I've been expecting at the time of the annual revisions in the summer that we would see some upward revision to GDP in the United States that would at least alleviate some of the what I perceive as exceedingly slow growth in labor productivity. But I guess I'm just going to have to give up on that expectation. We had another downward revision this past summer, suggesting that, in fact, we really are looking at relatively slow productivity growth. I should note the Institute's going to have a program on productivity in November. Hopefully we'll be exploring these issues in somewhat greater depth. So at this stage, 2.25%, gee, that's pretty solid growth relative to these estimates of potential output. So we're just going to need to adjust our sights. I do think there'll be some tick up in productivity growth over the longer haul as we see some recovery in capital spending and some capital deepening reemerge in the U.S. economy, but I'm not expecting that anytime soon at this point. So in terms of aggregate demand, relative to aggregate supply. It's still the case that the cyclical performance of the U.S. economy is being driven importantly by the household sector. We've got improving jobs, we've got improving balance sheets, both on the asset and liability side. Yes, this most recent downtick in the stock markets put a little dent in household net worth, but it's not fundamentally changing the fact that households' balance sheets have strengthened. And then declining energy prices also have been lifting disposable income, as you can see on the left-hand side of this picture. Now, I've heard a number of people say, gee, it looks like these lower energy prices really haven't led to any improvement in consumer spending. But in fact, I think the data say otherwise. As you can see, between 2011 and the middle of 2014, consumption growth was running pretty consistently at or below 2%, and really since the middle of last year has stepped up to a pace closer to 3%. To be sure, that's not all just the effects of lower energy prices, but it's also the effects of the wealth effects associated with the increase in stock and house prices and the improving labor market conditions as a whole. Housing, where we have been, I think, in general, been telling a story that we're expecting to see continued recovery in the housing markets. You know, for a long time, housing had been held back by tight credit, high vacancy rates, and the fact that we weren't really seeing any household formations occurring. And we've obviously still have tight credit. Vacancy rates are down considerably, but I think one of the more encouraging developments recently for the U.S. housing market has been a step up in household formations. It probably is reflective of the improvement in the labor market and a greater sense of confidence on the part of especially young people, but others as well, to actually start forming households again. And I think that's going to help lift housing construction activity over the course of the next few years, even as mortgage rates begin to start rising. The area, obviously, that I guess we had anticipated was going to be under some pressure is, in fact, manufacturing. No doubt, the deceleration that we've seen in industrial production in recent months is partly a reflection of the fact of the strengthening of the dollar and some weakening of activity abroad. But as you can see on the right-hand side, more forward-looking indicators also are suggesting that this softening is likely to continue. New orders index for manufacturing. This does not include this morning's data, which had another further step down in the new orders index. And export orders obviously now have dropped below 50, suggesting more firms are experiencing declines in export orders than increases. And so I think this is a reflective of the fact that we are going to get some drag from the appreciation of the dollar. In fact, I have in this forecast net exports subtracting about 0.5 percentage point from growth over the next couple of years. This weakness in manufacturing, however, has not been enough to derail the ongoing improvement that we've been experiencing in U.S. labor markets. There's been some slowing, to be sure, in the growth of payroll employment from the 250 pace per month to something closer to 200 more recently. But to put this in perspective, you have to remember that it only takes about 100,000 jobs a month to stabilize the unemployment rate. So we're still running well above that pace, and we're still running at a pace that's going to be capable of absorbing more slack in the labor market. And I think the single best high-frequency contemporaneous indicator of U.S. economic activity is initial claims for unemployment insurance, and they're certainly not suggesting that there's any broad-based problems that confronted by the U.S. economy or the U.S. labor markets currently. So I think we're still looking at a pretty good situation. So what about the policy assumptions underlying this forecast? I do think the Federal Reserve is eventually going to start tightening. In this forecast, I actually have that happening in December. I do think the pace of tightening is still going to be a bit slower than the Fed currently anticipates, although I think we've converged more recently. But I don't think they're going to be moving very quickly. On fiscal policy side, obviously the self-inflicted wounds that we were experiencing in the 2011 to 2013 period are over. I think federal fiscal policy is basically going to be a neutral effect for growth over the next few years, and we're going to get some small plus from state and local governments who are experiencing better financial positions, increased revenues associated with the ongoing recovery, and I think that's going to help provide a small boost to activity. we still got a lot of fiscal obstacles ahead, and my forecast does not contemplate that we actually run into a major problem in terms of lifting the debt ceiling or reaching some kind of a spending agreement, which I have, in terms of net effects, pretty close to what sequester levels would suggest. So there are clearly some risks to this forecast, and we could get to December and have a much messier situation that had real economic consequences and could have the side effect of pushing out the start date for Fed tightening even further. But that's not in this forecast currently. So we talked about risks and the asymmetric risk to the downside. So what if China falters? Now, we're not expecting the hard landing. I think Nick said growth of China in the 3 to 4% range was not plausible. Well, I guess I wouldn't use that word exactly. I'd say maybe unlikely. But one of the things that I think I learned from the financial crisis was it does pay to think the unthinkable occasionally. And so this is a simulation using Macroeconomic Advisor's U.S. model, MAUS, to simulate the effects of much slower growth in China, 3 percentage points below the baseline forecast. So that puts me in the mid-threes that Nick suggested was a low probability event, but again, which I think is worth thinking about. Then I wanted to look at a few other channels by which slower Chinese growth could affect the U.S. economy. One is there could be slower growth elsewhere in Asia and in other places like Latin America that have been dependent upon China's activity. So I've reduced growth in a number of these economies by the same amount that I did reduce Chinese growth. I would assume that a situation like this would probably be associated with a further depreciation of the yuan and probably other currencies of affected countries, resulting in this simulation in an appreciation of the US dollar by about 4%. As we saw this summer, concerns about China and concerns about global growth do have an effect on appetite for risk-taking. And in this simulation, I've assumed that there is a 10% jump in the equity risk premium and a corresponding decline in equity prices. And then in addition to that, some weaker global economy, weaker oil prices, that for the US economy still provides a little bit of an offset. So what are the consequences? As you can see, the second line, that lower left panel for US real GDP growth, alt scenario, that actually holds interest rates at the baseline forecast. And in that case, the Fed just sticks to its policy regardless of the fact that things are slowing down. That actually results in a very abrupt slowdown in growth. That obviously doesn't seem too plausible, so we turn on the Taylor rule reaction function that's embedded in the model and allow monetary policy to respond. And that does indeed cushion the growth effects of this shock and noticeably slow. So on the inflation side, in a world like this, the Fed is still miles away from achieving its 2% inflation objective. So how big is the monetary policy response in this situation? Well, as you can see on the left-hand side here, with the monetary policy reaction function turned on, we don't get a first tightening of Fed policy until the end of 2017. And in this reaction function, it actually wants to push nominal interest rates negative for a while as well, but because they're pinned at the zero bound, that doesn't actually occur here. The weakening of the economy that accompanies this is enough to reverse the decline in the unemployment rate and result in the case of no monetary policy reaction function, an increase in the unemployment rate of roughly 1 percentage point from current levels. And in the case where the monetary policy reaction function is turned on, maybe 0.5 percentage point. So in either case, a deterioration in the economic situation, what some would call a growth recession. But I think there's a key caveat to these simulations, and it's the following. What about situations? Do we see situations where the unemployment rate increases by 0.5 percentage point? Whoops, sorry about that. Somehow my animation didn't work here. But do we see increases in the unemployment rate of 0.5 percentage point outside of recession periods? And the answer to that is no. So the kind of scenario that I've shown earlier, with an increase in the unemployment rate of between between half a percentage point and 1 percentage point, simply has not occurred in the past. And that suggests to me that the real world may be more nonlinear than what the model is capable of producing, and suggests that there are more significant potential for recession risks associated with an outcome like this. That's particularly troubling because there's very little room to respond at this point. So with interest rates pinned at zero, monetary policy in these economies could return to a more aggressive form of quantitative easing, and indeed I would think that would be appropriate to do. But those effects are likely to be uncertain and certainly not necessarily going to be enough to offset the effects of a shock of the dimensions that I've simulated here. And on the fiscal side, I think you have some advanced economies, Japan, for example, with very little fiscal space left. Other economies, you could argue about the United States or Germany, that might have the fiscal space but lack the political will to actually do it. So I think that certainly suggests some risks as well. And then the fact that we're all starting with advanced economy inflation running so low, if you get hit with a significant negative shock at this point, I think that obviously entails much greater risk that you would get into at least risk the potential of a more deflationary type cycle. This isn't the worst case scenario. And I do think another point that I would want to make is, while we're all focused right now on China, there's a broader point here. I mean, any sort of significant negative shock to the global economy, given where advanced economies currently are, I think presents some very significant risks. That could be something like a geopolitical event that results in a very steep increase in energy prices, which has been providing a tailwind to many of our economies that would reverse. Or if you play chicken long enough and often enough with the government debt, and sometimes something can go wrong and you might actually have an accident in the United States, and that could happen relatively soon. So there are risks here. In terms of the inflation for the United States and starting out, it's really, I think, we're just not seeing any signs that you're getting any wage inflation whatsoever. I guess I'd call this is the employment cost index, and I guess I'd call my forecast here, I would not use the Fed's terminology, I'm reasonably confident of this forecast. I'd say I'm hopeful of this forecast. In addition, beyond the labor cost sides, we're not seeing any pipeline pressures either. And while the Fed has noted that these effects are going to be transitory, there's transitory and transitory. There can be transitory of a few months, and then there can be transitories of a year or so. And I'm not sure which one we're in, but I wouldn't necessarily bet that these effects will fade quickly. Inflation expectations, maybe they're stable, but I'd say the risks to stable inflation expectations at this point look more tilted to the downside than to the upside. And then on inflation, again, if my forecast comes to pass, we will have spent a decade in the United States below the Fed's 2% inflation target. So that's a long period of time. And if I were still back sitting around the table helping to edit the FOMC statement, I would take out the words, the first rate increase when they're reasonably confident that inflation is going to be. I'd say the Fed ought to be pretty darn sure that inflation is picking up before that. So in sum, I do think we'll muddle through. That's the most likely outcome, but I think the downside risks have increased. And I think most importantly, the consequences of a downside outcome materializing are really potentially quite large. So I think policymakers still need to be focused intensely on promoting growth and boosting inflation. So thank you.
Thank you very much, David. We'll come back to David for questions shortly, but we always try in our third seat at these meetings to give you something additional to think about. 6 months ago, it was Jacob Kierkegaard coming out with a way ahead of the curve positive forecast for Europe, or I should say optimistic forecast for Europe, which, as David noted, seems to be doing very well. Recently, we had one where Barbara Kochwar very early on flagged some of the more fundamental problems in Brazil, not just the cyclical problems, and that was another part of our forecast process and these kinds of events. Today I'm very pleased to be giving the stage to Paulo Moro, Paolo Moro joined us, I think, a year ago today officially. So October 1st is a good day. We also picked up another player to be named later today, but I won't talk about that. Paolo joined us after a long and distinguished career at the IMF, particularly in the research and fiscal departments. He's a widely cited and recognized scholar for his groundbreaking work on corruption, for his creation of great empirical work on fiscal policy, for co-authoring with Olivier Blanchard and others on rethinking macroeconomic policy, and has even addressed issues in Africa at times. And what Paolo's going to give us today is a preview or a work-in-progress check on a volume he's doing for the Institute with Thomas Hellebrandt on long-term projections of income and consumption around the world. And I think this is important. It's important on its own terms, but it's important today for two reasons. First is it nicely pulls together some of what we were saying about Nick Lardy's view of China, about the issue of rebalancing, with Dave Stockton's issues of what happens if there is productivity slowdown. So in the end, part of Paolo's message is how do fiscal policymakers adjust and think about when there's a productivity slowdown, when there is a fiscal pressure that comes with that. And he has some very provocative things to show you on that. And second, I think it's important, David made reference to the many emerging markets in trouble, not just where we called it on Russia and Brazil. It's important that Paolo remind us that while the BRICS may have been a bad bumper sticker, the idea of the future in Africa, in Latin America, and South Asia remains an idea that we should be taking seriously. And so, with all due respect to David and Nick's appropriate emphasis on the short term of the next 2 years, we also want to give you a look beyond that. So, Paolo, thank you very much.
Thank you, Adam. It's a pleasure to be able to address this audience, and I especially thank Adam for arranging a downpour outside, which means that I had prepared 8 slides, but now you're going to get the 80-slide version because you're not going to go anywhere. So my task today is, first of all, to get this on screen, is to get us all to step back for a minute from the usual forecasting exercise and think about long-run trends in the global economy and how those long-run trends can bring opportunities but also risks. Before I go to the risk side, though, let me begin with an optimistic view. I want to cheer you up a little bit, so I'm going to take the very big picture view of the world economy, and this is really from outer space, and then later on I'm going to talk a little bit more in detail. But look, the world economy is growing at 3%. It's projected to grow at 3.5% next year. This is pretty good. It could be better, of course, but in the grand scheme of things, we're going to double worldwide income within the next 20 or 25 years. How is this growth going to be distributed across countries? I would say, in the grand scheme of things, it's okay. The low-income countries, the emerging economies are growing on average still faster than the advanced economies. And that tends to reduce global inequality. Within countries, the economic growth is less well distributed, particularly in the main advanced economies, particularly in the United States. We're all familiar with the fact that even though the economy is growing, that's not filtering to the median incomes. So within countries, we're not doing so well. Let's put those two things together. On balance, the first effect of improving distribution across countries is prevailing over worsening distribution within countries. And in particular, what one finds is that over the past decade or so, global income distribution at the individual level has improved. So if you line up everybody in the world, all individuals from the very poorest to the very richest, and you look at how those individual incomes are distributed, you see that that distribution has been improving for a decade. Not only that, But if you make some assumptions about using consensus forecasts for growth and population and so on, we project in the study that Adam kindly mentioned that worldwide income distribution at the individual level is going to continue improving over the next 2 decades. So I wanted to start from this optimistic message, but now let me come to the risks, and risks that come from long-run trends. Normally, we don't talk about these in the standard forecasting exercise, but I would make the case that even though long-run trends usually affect us in a gradual way, there are many instances in which they interact with abrupt episodes so that they materialize and they affect the near-term outlook very abruptly. Just to give one example that is in the news, think about the migration crisis in Europe. We have differences in per capita incomes, we have differences in demographic patterns with aging in the European economies and strong population growth elsewhere. You interact that with a war. Unfortunately, that those episodes do occur and they do affect the near-term outlook. So that's just an example to come to the broader phenomenon. And here I would highlight 3 sort of themes. The first one is the possibility, which we have alluded to already in the case of China, but applies more broadly, the possibility of a sustained decline in trend economic growth, particularly in emerging markets. And particularly, this tends to happen historically related to geopolitical events or even violent domestic political disruption. The second source of risks from long-term trends I would point to is the large differences in demographics across continents. And I gave the example of migration, but it applies more broadly. And the final point I want to come to, the final issue, is if there is a decline in long-run growth rates, how should macro policy adjust? And in particular, how should fiscal policy adjust? So let me now come more specifically to forecasting exercises, and I'm going to focus on long-run economic forecasts with a particular emphasis on emerging economies. And I'm going to go back a year. One of the first things I did when I joined the Institute was to work on a policy brief with a colleague. And there we looked at the long-run economic forecasts and tried to assess whether they were on balance okay or not. And we found that they were overly optimistic. And let me just give you one example of the evidence that we have to support the view that long-run economic forecasts are particularly optimistic for emerging economies. What I'm showing in this chart is on the vertical axis the consensus forecast for economic growth in the next decade. And on the horizontal axis, I'm showing actual past growth in the previous decade. What we also did was to look historically. We took 50 years of data and many countries, and we ran panel estimation trying to find out what is the actual empirical association between growth in a particular decade and growth in the previous decade. So how much autocorrelation, how much memory is there in the process? And if you use the estimated coefficients from that relationship, you get the red line that I'm displaying on the chart. That tells you if I'm a cold-hearted statistician who doesn't know very much about the specifics of the country, and I know what past growth was last decade, the red line gives me what should be my forecast. What's immediately apparent from the chart is that most forecasts, most consensus forecasts, are above the line. So on average, forecasts tend to be overly optimistic compared to my cold-hearted method. This is particularly the case for the emerging economies. For those of you who are familiar with similar work by Lan Pritchett and Larry Summers, there's a lot more here that I want to point to. not only do we have more countries, more years, and longer horizons, but we have some additional findings. One is that the degree of optimism becomes greater the further out into the future we go. So for longer horizons, there's more over-optimism. The other thing that we found is that this is not just a matter of over-extrapolation of recent growth. It is also the case that even for emerging markets that went through a major disruption, had very, very low growth, even negative growth in the previous decade, even for those countries, we find over-optimism compared to what one would normally expect. And where is this over-optimism coming from? Well, we relate it to geopolitical events. We relate it to domestic violence. The reason why people tend to be over-optimistic historically on emerging economies is that normally when you do your forecast, you tend to assume that the politics is going to hold together. You don't insert a war, or you don't insert a civil major episode of domestic violence in the country. So in a large sample of countries, unfortunately, those events happen, and those are a source, when you look at the data, those are a source of over-optimism in our forecasts. Now, what happened since last year, of course, is that Russia is now in recession, Brazil is in recession, we're talking about a slowdown in China, so in some ways we feel that we raised an important issue. But I do remain actually bullish on emerging markets in the long run. So on the one hand, I do think that we tend to be overly optimistic for emerging markets, but the reality is that these will be the engines of global growth going forward. And where this is not going to happen, most likely it will be because there's some war or some other disruption politically that we cannot really anticipate. Now, what does this imply for us? Well, in terms of the kind of optimistic side, certainly I think this calls for both companies and governments to kind of prepare for a massive growth in consumption in the emerging markets and for major shifts in the composition of that consumption. So what we will certainly find, for example, is that there will be a decline in the share of food in total consumption and a massive increase in the share of transportation, which in turn will necessitate the buildup of infrastructure. For us as analysts, the implication is that perhaps we should spend less time focusing on baseline forecasts and much more time on doing the kind of thing that we just saw from Dave's earlier presentation. We need to think through downside scenarios much more often than we do. We need to spend more time doing that. Now, in terms of the opportunities, but also in terms of the risks going forward, let me just highlight the issue of demographics. And I like to show this very often. I hope you kind of share the message. It's important that we keep this in mind all the time. As we all know, with aging of the population, not only the advanced economies, but also in China, we're not going to see a whole lot of population growth going forward. However, in India and other parts of East Asia, emerging East Asia, we will still see healthy population growth, 300 million more people in the next 2 decades in India alone. And in sub-Saharan Africa, we are about to witness a massive explosion of population. In fact, this is historically unprecedented. We're going to see a population that goes from the current 900 million to 1.6 billion in the year 2035. So this is obviously an opportunity for businesses, lots more consumers, lots more workers, but it can also generate risks in the form of migration or in the form of political events. The last issue I want to mention during this presentation is to think about what happens if long-run economic growth declines and how should macroeconomic policies, fiscal policies in particular, adjust to a potential decline in the long-run rate of economic growth. And to do that with some colleagues, what we did is to gather data for 200 years, 50 countries on public debts, fiscal deficits, economic growth, interest payments, and so on, and run a bunch of regressions. And this is very topical because, as we know, in the aftermath of the global economic and financial crisis, we probably have seen a decline in long-run economic growth in the advanced economies going forward. And certainly it's something that we are discussing for the case of China, as noted in the first presentation today. So what do we find? The key result that I want to highlight here is that when there's a decline in long-run economic growth, policymakers tend to misread it as a temporary slowdown. So in real time, contemporary policymakers don't realize that the rate of economic growth has declined permanently. They rather think this is just a cyclical development. And therefore, rather than saying, well, the economic growth is lower, therefore we're not as rich as we thought we were going to be, therefore we should adjust our expenditures accordingly. Rather than doing that, policymakers tend to fight the decline in growth as though it was a recession, and they tend to provide fiscal stimulus. So what happens is that the structural fiscal deficit becomes larger and debt to GDP ratios balloon. We've seen this as a source of public debt crises and near crises historically in many cases, certainly in the low-income countries. I always give the case of Cote d'Ivoire, which is the most striking, but many African countries, many low-income countries in the 70s and 80s, they were growing healthily and then they stopped, and then they went into debt crises. We've seen it as a source of debt crisis in Latin America. And certainly this has been an element in the rise in advanced country debts in the 1990s. The most striking illustration of this phenomenon is from Japan, which of course has not had a fiscal crisis, but certainly has seen a very large increase in the debt to GDP ratio. And as we all know, growth in Japan was very strong, maybe 10% or so, up to the first oil crisis. But then afterwards, it declined in a sustained manner through the early 1990s. And then with the bursting of the asset price bubble in Japan, we have another decline in the long-run economic growth rate. And look what happens to the debt to GDP ratio. In the 1950s to the 70s, the debt to GDP ratio is very stable. Japan is growing very fast. Things are okay. But then after the first oil shock, the debt to GDP ratio starts rising very rapidly. There's an adjustment toward the end of that decade, but again, with the second drop in the growth rate, we see another major increase all the way to 250% of GDP. This is a very striking example, but we have documented that this is a more generalized pattern that applies to all countries. And what I want to leave with you is the question of, if the long-run economic growth rate in the advanced economies or in China or elsewhere has declined, then what should we do in terms of fiscal policy going forward?
Can I ask, we're going to now open it up for questions. Thank you for everyone for sticking with us. I'd like to ask Dave to take the center seat, as he's the center of this exercise. Paolo to take the extreme right wing with his fiscal prudence, and I will come up on the left wing dovish side. This is not one of those games where you have to try to link up everything in one big question. You can ask anything specific to David or to Paolo that you care to. I see a gentleman at the back mic, please.
Barry Wood, RTHK in Hong Kong. Dave, this is a journalistic question, I admit, but I just don't see how the conclusion that you reach on U.S. growth goes down to 2.2 and then even lower in 2017 when you've got that when you've got employment growing at a healthy clip, you said housing has a firmer footing, the oil price has clearly boosted things, and also we have autos at a, record high. How does that follow?
So quite simply, it comes about because tightening monetary policy makes it happen in this forecast. So there is a sense in which rising interest, as the Fed sees the unemployment rate moving down, it begins to raise rates. That, in fact, does have an effect on interest-sensitive spending. As you noticed in my housing picture, even this recovery in housing has still been relatively low by historical standards. We're only getting back to the 1.6 sort of equilibrium level by the end of this period. So I think you get a little bit of modest slowing from the tightening of policy and sort of the end of some sort of multiplier accelerator effects that sort of accompany this thing. You will get a slowdown. So I didn't show my forecast of employment growth. And I think if I'd shown that, you would see, in fact, employment growth slowing to about the 100,000 a month pace out in the end of 2016, 2017 period. So this all sort of fits together with a sort of a policy-induced modest slowdown that we still get a little bit of overshooting on the unemployment rate, but not very much. And that is sort of I think, the basic objective of monetary policy at this point.
Just one quick follow-up on Barry. I mean, we are the Institute for International Economics. What role does net exports play in this story, and what role does the past appreciation of the dollar play?
So, I mean, it's, as I think I mentioned in my presentation, I do think that the appreciation of the dollar is likely to weigh significantly on domestic production, taking off about a 0.5 percentage point out of growth over the next couple of years. That eventually fades a little bit as well as you move forward. But that's still got a couple of years worth of restraint coming from that channel.
Sorry, just to be clear, 0.5% cumulative over a couple of years, or 0.5% per year?
0.5% per year for the next couple of years and then beginning to fade out.
Thank you very much. Please.
Yeah, hi, I'm Cullen Hendricks. I'm here with the Institute and the Corbell School at the University of Denver. My question is for Paolo. I'm involved with several sort of fairly large-scale attempts to try and forecast political instability, and it turns out that we as a community of people doing that are very bad at doing that. So it makes sense that these are not included in kind of conventional forecasts of macroeconomic output. But there are some things we do know. We do know that they occur. We do know that they tend to cluster in very low-income countries. And we also, unfortunately, know, based on research that's come out of IMF and the World Bank, that absent intervention by either multilateral development agencies or direct aid from major powers with better resources with which to invest in these enterprises, that you don't get a post-conflict return to economic growth. So even if we don't know exactly where these conflicts are going to break out, we do know that there needs to be some engagement by the international community to help these economies rebound. How can major economies think about their commitments to doing that over the long term and incorporate that into their budgeting processes?
And to give Paolo a moment to formulate his response, I'll just feature we're very delighted that Cullen, who's a non-resident senior fellow with us, is with us this month. And I encourage Paolo and Cullen to get together and maybe co-author something on this. But anyway, Paolo.
Well, I think as you're implicitly indicating, I'm not sure I can do justice to the question so quickly, but I will say that indeed what you just highlighted is the reason why we see this tendency for us to be overly optimistic. I mean, one way to get around it might be to say, well, here is what happens to the economy if things go well, and here is a disaster scenario. Then comes the harder policy question, how to avoid that disaster policy scenario. And there I think we have to go into complicated politics. So I'll abstain from that.
Great, thank you. Please.
Bill Klein here at the Institute. David, I was surprised that you got so much downside from China's having 3% slower growth. If you take the trade numbers, U.S. exports $125 billion to China. Let's say you get the 3% decline, so let's say there's a 7% decline in U.S. exports to China. Let's say that you have an equal impact because of your assumption about the Brazils, et cetera. you're still talking, and you accumulate it over 2 years, still talking about 0.2% of U.S. GDP. Now, you parlay that tenfold to a 2% of GDP loss over that period of time. Seems to be driven very heavily by a stock market shock, by a further dollar depreciation. And yeah, we saw the stock market get unhappy because of China fairly recently, but my suspicion is that over that period of time, the stock market would start to realize that exports to China are not that large. I mean, in sum, I'm a little surprised about this huge multiplier effect that you get from China to us.
Okay, so to begin with, if it was just China, it would be almost inconsequential in terms of its GDP effects. You're right, the trade shares there are just small. In fact, the hit, what goes into this model is export-weighted foreign GDP growth that goes into the US model. In fact, the cumulative shock that I gave to that was a little bit more than 0.75 of a percentage point. So you start out with 0.75 of a percentage point just coming from the collection of China, Asia, and some Latin America as well. So it's a bigger shock than I think than perhaps you were suggesting here in terms of the collection of countries that I have affected. Then, in fact, you can argue about whether the equity, so in that case, it's a pretty much a substantial sort of hit to global growth in foreign activity. I do think that would have some more lasting effect on appetite for risk and the uncertainties. And if you start looking at sort of the kind of growth picture that I'm showing in that simulation, it's a very soggy growth. And in fact, I think some of the financial market reactions more recently to concerns about China and emerging markets, I do think are a reflection of some of the concerns that I'm pointing out in my presentation, which is there really the capacity of advanced economies to have policy that would respond to a shock of this dimension? So I'm not too uncomfortable with the notion that there could be some significant pulling back from risk-taking in that case. And then there's another, the exchange rate channel as well, further depressing demand for U.S. production. And I think that channel as well. So those things add up with some multiplier accelerator effects and with hitting the zero lower bound so that you can't even in the context of this model, get a significant policy offset to produce, I think, a significantly weaker outcome.
Now, we're going to be, as Bill and David are aware, we're going to be doing some internal discussions on this very question of what does it matter to the U.S., to the world, if China turns out not to be Lardy-esque. So watch this space. There will be more to come. Yes, please.
Thank you. So for Dave, looking at the domestic side of your forecast, you mentioned that I can't remember whether it was your ECI or your domestic inflation forecast was more hopeful than reasonably confident. Obviously, we've seen a surprising pattern over multiple quarters now where tightening resource utilization at home has not led, as swiftly as anticipated at least, to rising domestic wages and costs. It seems there are multiple different explanations of why that could be so. Could just be unusually long lags. Could be that we've got Nehru wrong. It could be that there is some deeper change or disruption in the inflation process itself. Could you sort of walk through how you think about that set of issues, how you explain the slowness of these pressures to turn up, and how confident you indeed are that they will show over the next several quarters ahead?
So I can answer that last piece, not very confident. In fact, my forecast on the ECI is below consensus, and my inflation forecast is below consensus. So I think a couple of things. One is, like Paolo's statistician that he talked about, I think any reasonable policymaking institution would want to respond to these developments by adjusting, to some degree, its estimate of the Nehru. The Fed has done that a little bit. It's come down. But in fact, I think there is room for them. I think they are likely to lower it further. I think the evidence that that 5% is a balanced estimate of the NAIRU at this point seems not to be there at this point. So I think there's more slack. That's one thing. I wouldn't rule out the possibility that there are some lags. You know, even sort of the standard inflation models can only explain about 50% of the year-to-year variation in inflation. So it could be just random chance or whatnot that's producing lower effects. You know, we ran an economy with an unemployment rate of 4 to 4.5% once in the late 1990s, when admittedly we were experiencing a very positive supply shock, but also once in the 2000s where we got 4.5%, and we didn't see substantial pressure there. So the NAIRU could be lower. It also could be that the wage setting process is more nuanced than the models that the sort of typical linear Phillips curve type models that we run. You know, I think it can be the case that sort of a wage norm has developed. If you look at that average hour, if you look at all those wage series that I showed, it's amazing how rock solid they are at 2%. And it's quite possible that the way there's an institutional sort of issue in wage setting, which it could very well be many personnel departments say, you know, we gave 2% last year, we're going to give 2% this year. The people on the floor aren't really knocking at the doors yet saying it's impossible to find workers. They might be coming more frequently, but it might take something more significant, a more significant difficulty in hiring before, in fact, you break out of that 2% range. So, you know, these are speculations. I don't have an empirical-based answer for your question, but I guess if I were in a policymaker's position of trying to make an estimate here, I would be quite humble about my ability to estimate it and quite flexible in adjusting to incoming information.
Great, thank you. I think we're going to close it out there. This has been a bit long, but I think a very rewarding session. I want to thank Paolo for giving us the clear-eyed statistician and the long view. I want to thank especially Dave, of course, for leading this process. A lot of internal discussions and a lot of work from him and his colleagues makes this happen. And obviously thank Nick Lardy for getting us off on such a provocative start. We look forward to seeing you all again. There are many exciting events coming up at the Institute. Dave mentioned in mid-November we're doing a major conference on the global productivity slowdown, including speakers Robert Gordon, Larry Summers, John Van Reenen, and specialists on various countries who will be coming here to speak. We also have coming up in the next couple weeks event on October 14th on long-term growth prospects for Europe, specifically that Jacob Kierkegaard's put together with our friends from McKinsey Global Institute. And on October 15th, a drill down on the spillover effects of quantitative easing and unconventional monetary policy on other countries, which was put together by our colleague Joseph Gagnon. So we'll look forward to see a lot of you, and I assure you, the minute they announce a TPP ministerial, we will be having a lot of events on that. In that note, thank you all very much. This meeting is adjourned.